So what do you get when you mix a record-breaking gold rally, a dollar flexing its muscles once again, and a US government that's been shut down longer than most traders' sleep cycles? That's right, market madness with, well, a little dash of irony. So before you place your next trade, trust me when I say you are going to want to watch this. Good morning, I'm Francois, your market analyst here at ATFX Africa, and welcome to your daily market brief. Each morning, I unpack the biggest market movers across currencies, commodities, and indices, blending fundamentals, technicals, and just the right amount of common sense. Because let's face it, markets don't always make sense. Let's kick things off with currencies, and we are going to kick things off with the cable. So the pound has slipped as fiscal jitters meet a stronger dollar. The British pound extended its decline, falling to a 9-week low around $1.33 as traders braced for the upcoming UK November budget and continued dollar strength. The market's narrative is increasingly dominant by fiscal caution in the UK and political dysfunction in the US, an ironic pairing where both governments are well under pressure. Yet only one currency, the dollar, is benefiting. From a UK perspective, investors are worried that the Treasury's upcoming fiscal plans could tighten spending at a time when the economy is already fragile. Slowing wage growth, persistent inflation, and soft consumer demand have kept pressure on the Bank of England to maintain, well, a bit more of a cautious tone. Governor Andrew Bailey reiterated this week that the bank won't rush into rate cuts until there's clear and sustained evidence that inflation is under control. Across the Atlantic, the US government shutdown, now in its 10th day, hasn't dented the dollar's appeal. In fact, safe haven flows are strengthening the greenback, especially with other major economies slowing down. The result? A divergence in confidence. Markets trust the Fed's credibility more than the UK's fiscal outlook. Technically, GBP USD is under sustained selling pressure, with the pair trading well below its 20 and 50-day moving average. Immediate support currently lies at 1.328, followed by 1.316, while resistance forms near 1.333 and 1.345. Momentum indicators remain bearish but oversold, suggesting potential for a short-term bounce, though the fundamental bias still favors the dollar. Moving over to commodities, and we are going to go to our shiny metal. Gold's glittering run faces a reality check slightly, as gold has been on a record-setting spree, touching an all-time high above $4,000 per ounce earlier this week, and heading for its 8th consecutive weekly gain. That's not just impressive, traders. That's an Olympic-level endurance impressive. But the shine dimmed slightly yesterday, as the metal dipped to around 3,950, with traders locking in some profits and the dollar flexing on those multi-month highs. The key driver here isn't just inflation and rate cuts, it's uncertainty fatigue. The US government shutdown continues to choke off official economic data, forcing markets to rely on private indicators. Add to this that, we still have geopolitical tension from Ukraine to the Middle East, and gold safe haven appeal also remains rock solid. So from a monetary policy standpoint, the picture is nuanced. The latest FOMC minutes revealed that policymakers see rising risk to the labor market, but remain wary of inflation, meaning rate cuts are still likely, just not too fast. Then, New York Fed President John Williams struck a balanced tone, saying he's open to another rate cut, but mindful of inflation risk, which translated from Fed speak means we might cut, but not if it looks too easy. That cautious tone has capped gold's momentum for now. Technically, the metal sits in a tight range between 3,940, which is the support, and 4,058, which is the resistance. The recent drop below the 100 moving average, and this is the 100 moving average on the hourly time frame, hints at a short-term exhaustion. But as long as the price stays above 3,900, the uptrend remains intact. On a daily time frame, the RSI shows mild overbought conditions, signaling potential for a short-term consolidation before that next leg higher. So in essence, the gold story isn't over. It's just taking a breather. With the shutdown unresolved, data delayed, and rate cuts still on the table, the backdrop remains supportive. But as traders know, what goes up like a rocket often pauses before the next launch. Finishing things off with equities, the S&P 500 finally took a step back yesterday, slipping around 0.28% after a record-breaking run that had investors wondering if stocks had forgotten how gravity works. Several narratives are all colliding here because of this. First, the AI-driven rally that has powered tech and growth stocks is showing early signs of fatigue as valuations are stretched to their limit. Second, the US government shutdown is delaying critical economic releases, meaning investors are navigating without their usual compass of macro data. And third, earnings season is right around the corner once again, with Citigroup and JP Morgan set to report next week, both viewed as bellwethers for the broader economy. Despite yesterday's wobble, the S&P edged higher this morning, signaling that optimism isn't dead, it's just cautious. Encouraging earnings from Delta Airlines and PepsiCo, both up more than 4%, suggest that consumer demand remains steady despite the macro headwinds. Meanwhile, the volatility index ticked slightly higher to 16.4, showing traders are, growing a bit more defensive but not panicking. Technically, the index hovers around 6,744, just shy of its all-time high at 6,765. Immediate support lies at 6,720, with deeper buying interest near 6,700. The trend remains structurally bullish but stretched, much like traders' patience currently with the Washington budget talks. The key theme: momentum versus uncertainty. AI and strong corporate earnings are pulling one way, while politics and delayed data pull the other. If next week's bank results show solid lending activity and credit demand, the market could quickly find its next gear. Today, however, we will see the release of the University of Michigan Consumer Sentiment Report, which will be the only major release on traders' radars more or less this week. And it carries extra weight given that the blackout of key US data. A weaker print could signal cracks in consumer confidence, potentially reinforcing the Fed's dovish stance. Meanwhile, the postponement of the NFP report to October 17th effectively pushes major market catalyst into, next week, ensuring that volatility remains contained but simmering just below the surface. And with that, we wrap up your daily market brief, brought to you by ATFX Africa, the broker that gives you an edge in today's markets. Head over to ATFX Africa by clicking the link in the description and go and experience the difference for yourself. It is until next time, stay sharp, stay focused, and trade smart.